everyone, welcome to our video on investment decisions, a key topic in business finance module. Today, we are going to walk you through how businesses decide where and how to invest their money using both theory and real-world examples. In the next few minutes, you'll learn what investment decisions are, the different types, how companies evaluate them, and what factors they consider. And in the second half of the video, we'll show you how these decisions are applied in the real world by major companies in Sri Lanka. Let's dive in.
Now I'm going to explain a key financial concept that every business must get right: capital budgeting, also known as the investment decision. So what is it? Capital budgeting is the process businesses use to decide which long-term investments are worth pursuing. It helps determine whether a project like expanding a factory, launching a new product, or upgrading technology will generate profitable returns. In other words, it is how a company makes smart investment decisions about where to allocate its resources. Now, why is this so important? Because these decisions typically involve large sums of money, they are not easily reversible, and they shape the future of the business. A well-evaluated investment then can lead to business growth, reduce financial risk, and ultimately maximize shareholders' wealth. Key features of capital budgeting include investing current funds for future benefits, focusing on long-term assets, and expecting return to come over several years. In short, capital budgeting is the backbone of strategic investment decision making, guiding businesses toward future-focused financial choices.
Let's take a closer look at the types of investment decisions that businesses make as a part of the capital budgeting process. Investment decisions are crucial because they involve committing large amount of funds to long-term projects. These decisions are classified into two major categories. The first one is based on purpose or objective. These decisions focus on why the investment is being made. Here are common objectives. First one is expansion of existing operation. For example, increasing production capacity. And the second one is starting a new business, entering a new market or industry. And the third one is replacement and modernization, updating old machinery or system to improve efficiency and reduce costs. The second one is based on relationship between investment. These decisions focused on how different projects related to each other. So the first one is mutual exclusive investment, selecting one project rules out to others. And the second one is independent investment. Each project is evaluated on its own merit. Last one is contingency investment. Where accepting one project depends on undertaking another. Understanding these type of investment decisions help business plan strategically and minimize risk and also achieve long-term profitability.
Now I am going to explain 4 common investment appraisal methods used in business finance. So let's get started. First one, payback period. This method tells us how many years it takes to get back the money we invest. The formula is initial investment divided by annual cash inflow. It is easy to understand and useful to know how fast we recover our money, but it does not consider any profit after that point, and it is also ignore the time value of money. Second one is net present value. NPV is one of the most reliable methods. It considers the time value of money by discounting future cash inflows. The formula is present value of cash inflow minus initial investment. If the NPV is positive, we accept the project, but if it is negative, we reject it. This method gives a more accurate picture even though it is a bit harder to calculate. Third one is internal rate of return. IRR is the rate at which the NPV becomes zero. It shows the expected return percentage from the project. If IRR is higher than the required return, the project is considered good. But calculating it usually needs trial and error or software tools. Last one is accounting rate of return. ARR looks at profit instead of cash flows. The formula is average accounting profit divided by initial investment multiplied 100. It is simple and uses accounting data. However, it ignores the timing of cash flows and the time value of money. So, those are the 4 common methods.
Let's now move on to investment evaluation criteria, which guide how capital budgeting decisions are analyzed. There are 3 key steps in the evaluation process. First one, estimate future cash flow of the investment. Second one, determine the required rate of the return, also known as the discounted rate. Third one, apply a decision rule of assess the project's financial viability.
When we talk about type of evaluation method, we evaluate investment using 2 main type of methods. First one, discount cash flow methods. These consider the time value of money, making them more accurate of the large term decision making. Common DCF techniques include: first one, net present value; second one, internal rate of return; third one, profitable index; fourth one, discounted payback period. Second method, non-discounted method. These are simpler but do not account for the time value of money. Examples are payback period, accounting rate of return.
Now we are talking about investment decision rules. A good investment evaluation method should maximize shareholder wealth, consider all relevant cash flows, objectively distinguish good project from bad, enable ranking of projects by profitability, perform large and earlier cash flow.
Let's discuss the key factors that influence investment decision and essential element of capital budgeting. Investment decisions are not made in isolation. They are influenced by a variety of internal and external factors. Here are some of the most important factors. Cash flow projection. Accurate and reliable forecast of future cash flows are the foundation of any sort of investment decision. Required rate of return. This represents the company's cost of capital and reflects the level of risk involved in the project. Project risk. The higher the uncertainty surrounding a project, the more cautiously it must be evaluated. Availability of funds. Even profitable investments may be postponed or rejected if sufficient capital is not available. Regulatory and economic environment. Elements such as tax policies, inflation, interest rates, and the legal framework can have a major impact on investment viability. To summarize, capital budgeting is the process of making long-term investment decisions that significantly influence a company's future. It involves evaluating potential projects using both discounted cash flow methods such as net present value and non-discounted techniques like payback period. The objective is to apply decision-making rules that maximize shareholder value by selecting the most financially viable opportunities. Ultimately, successful investment decisions rely not only on strong financial analysis but also on strategic alignment with the company's long-term goals.
Welcome back. Now that we have explored the theory behind investment decisions, it's time to shift our focus to the practical side. In this part, we'll look at how these concepts are applied in the real world. Let's dive in the practical application of investment decisions.
Omega Line Private Limited is one of the largest apparel manufacturers in Sri Lanka and the key subsidiary of the Italian Calzedonia Group. It plays a major role in producing garments for world-renowned fashion brands like Calzedonia, Intimissimi and Thessanis, supplying mostly to European and North American markets. In Sri Lanka, Omega Line operates multiple manufacturing facilities with its main plant located in Sandalankawa in northwestern province. It also has additional sites in Vavuniya, Kilnacchi and Nayapana, providing thousands of local employment opportunities. The company is widely recognized for its ethical labor practices lean production system, and strongly focus on sustainability. By combining skilled craftsmanship with advanced technology, Omega continues to grow globally while strengthening its roots locally.
At Omega, the company approaches investment decisions based on the specific requirement rather than following a fixed or routine plan. It all begins by assessing whether the existing resources can be used more efficiently to meet the need. The mindset isn't to invest immediately, it is to first explore if the goal can be achieved with what's already available. For example, if a certain production level is needed, say 100 units, the team first look at how much can be done using the current machinery in normal working hours. If that's not enough, they consider running additional shifts. Only as a final option would they look at purchasing a new machine. This shows that their investment approach is based on practical analysis and cost-conscious thinking. When it comes to approving an investment, Omega looks at whether the decisions would result in higher productivity, cost savings, and long-term value for the company. The tools they use for this include net present value and payback period, both of which help them understand how profitable or beneficial the investment will be. Another interesting part of their approach is the idea of backward integration. The company believes in being independent, which means minimizing reliance on external suppliers, especially for accessories and materials. For that reason, they may invest in internal capabilities, which allows them more freedom to make changes, improve designs, and operate with greater flexibility. So, overall, at Omega, investment decisions are not just financial, they are strategic, resources conscious, and always tied to the company's long-term goals.
At Omega Line Private Limited, investment decisions are made using only two key financial techniques: net present value and payback period. These tools help the company decide whether a proposed project is worth the cost. According to the capital budgeting representative we spoke with, Omega usually expects a payback period of not more than 2 years. That's because in the apparel industry, timing is everything. The company uses market-based interest rate when applying NPV calculations, and currently they rely on rates provided by Deutsche Bank, which is their main banking partner. When it comes to choosing between two potential projects, Omega compares both the NPV and payback period. If one project has a shorter payback and a stronger NPV, that one will be usually selected. However, they also consider real-world conditions like how urgent the need is or how fast a fashion trend is shifting. For an example, we were told about how branding styles changed. In the past, brand labels were stitched separately on garments, but now many customers expect labels to be printed directly on the fabric. But now, many customers expect labels to be printed directly on the fabric. This meant Omega had to invest in new printing equipment. Even though it was an unexpected change, the company used its investment techniques to evaluate the cost and make quick decisions based on both financial return and fashion urgency. So in real life, Omega applies financial tools but also with practicality, timing, and flexibility in mind.
To bring everything together, investment decisions are a big part of how a company plans for growth. In PL methods like net present value and payback period help evaluate whether a project is worth the money and time, and how soon the returns can be expected. At Omega Line Private Limited, these two tools, NPV and payback, are the only ones they use when analyzing investments. They don't use other financial methods like IRR or ARR. What is interesting is how they handle decisions practically. For example, if they need to increase production, they don't immediately go for a new machine. They first look at running longer shifts or optimizing current resources. A new investment is only made when those options no longer meet the target. So, in the end, investment decisions aren't just about finance, they are also about practical thinking and making the best use of what a company already has.
If you enjoyed this video, don't forget to like, share and subscribe to our channel for more educational content. Thanks for watching and see you next time.